We shall continue. Okay, European options on stock paying a continuous dividend yield. What do you mean by continuous dividend yield is that when we get the same probability distribution for stock price at time t in each of the following cases. Let's say stock starts at price S0 and provides a continuous dividend yield Q, which is normally in a percentage. You can't adjust percentage to dollar value of S0. So therefore, we use it on a continuous exponential basis to discount it. So stocks that start at the price of S0 exponential to the power of minus Q times T. The T here is important, that when is the dividend is provided, because it's continuous. We don't have 1 month, 2 month, or 3 month during the lifetime. We just follow the lifetime of the option and provides no income. Okay, there's no, what do you mean by provides no income is no dollar income. It is a percentage. Therefore, it's S0 exponential to the power of minus Q times time. Let's have a look at one example here. Let's say pricing formula for continuous dividend is here. S0 exponential to minus Q times T, and the rest of it times ND1 minus KE power of minus RT, ND2 is same. So this is the call equation, and put equation is same thing there, where it affects is only the S0 part of it. So S0 part of it is adjusted by discounting with the Q. Anyway, when you're calculating the D1, what has changed is the S0 is still S0. We are not adjusting that because there's no dollar value to adjust. But we are adjusting it at the interest rate. Risk-free rate is R. We minus the Q. Assumably, the Q is smaller than R. The rest of it is same. Sigma squared divided by 2 times time divided by sigma square root of T. So of course, once you get the D1, then the D2, you know how to calculate. It's easy. So take into account of this, where R minus Q is the only difference here, right, in the D1 equation. While in the call equation, it is adjusting to the S0. In the put equation also, it adjusting to the S0. Okay, this is the only difference you can see. Okay, index options. Now we are moving into index options. Are used for hedging purposes mainly. One is diversification, but the other one is isolate systematic risk. Are extensively used for portfolio insurance mainly, buying puts against the spot index, most common. In fact, I am happy to test you all on this, because how do you manage a portfolio insurance? Like say for example, US index options are given. So many indexes are there that the most popular underlying indices in US is Dow Jones Index, which is called the DJX times 0.01, Nasdaq 100 Index NDX, the Russell's 2000 Index, the RUT, S&P 100, OEX or XEO. The only OEX is American. Okay, the rest is European. I may not test you on anything called American. S&P 500 index and SPX and all these things are index options. We have index options. You don't have to worry too much about this. Okay, index options. What about issues in the index dividend payments? This is where we use continuous flow of dividends, because you can identify a specific dividend for one share there because it's an index. We assume that the index pays a continuous flow of dividends, allowing us to use dividend yield in the BSM analysis as what you saw in the last slide. The problem is dividend typically displays a strong seasonal character. There is interim or final depending on the year tax cycle period, but we don't have to worry about that. Prediction of dividend components become more important, but prediction errors might cancel off more easily, because how do they look forward? What kind of dividend should be paid? If there is a declaration, then it's confirmed. Otherwise, you have to look for some kind of exertion. Okay, currency option. As I told you in the initial stage, Currency option primarily trade in the OTC, that's over-the-counter market. Currency options are used by corporations to buy insurance against their foreign exchange exposure. Again, I told you it depends on whether what kind of exposure are you facing. Are you facing the exposure to pay something in a foreign currency? Are you facing an exposure receiving foreign currency? The advantage of OTC market is that the contracts can be tailor-made for the amount what you are receiving at a certain expiry date where you require to suit the needs of the companies using them. Okay. For example, a European call option gives the holder the right to buy 1 million euros with US dollars at exchange rate of 1.2 US dollars per euro. Let's say there is a strike. You've got a strike to buy a European call option on 1 million euros. The cost you are fixing at a strike is 1.2 US dollars. So if the actual exchange rate at the maturity of the option become 1.25, the payoff is that 1 million times 1.25 minus 1.2 because you still can buy the 1.2. But let's say the currency market on the day at the expiry is quoted as 1.25, then you save that 0.05 times 1 million, which is 50,000. If the actual exchange rate at the maturity of the option is lower than 1.2, then the option will not be exercised. But you will be losing the cost what you paid to buy that option. That's example 1. But let's say in example 2, the European put option gives the holder the right to sell 10 million Aussie dollars for US dollars at an exchange rate of 0.9 US dollars per Aussie dollar, let's say. Now you are supposed to, let's say you are an American company, you are receiving Aussie dollars, and what are you going to do with the Aussie dollars in US? You have to sell it to buy US dollars. So you are selling it at 90 cents, 90 US cents per Aussie dollar. If the actual exchange rate at the maturity of the option is become 0.87, then the payoff is that you are still going to sell it at 90 cents. 10 million times 0.9 minus 0.87, you save about 300,000. The actual exchange rate at the maturity becomes higher than 0.9, then you might as well sell it in the market, abandon the option. It's as easy as that. Well, currency options can be calculated in many ways and all these things. I'm not particularly going to cover this part of it for you because it's out of scope. Okay, and not necessary to follow this. Well, futures options. Futures options are defined, mechanics of the position, pricing for premium paid upfront, pricing for margin premiums, reasons for popularity of the futures options are we'll discuss. Okay, futures options. What exactly futures options are attractive when the underlying is difficult to deal with. Example, commodities. Because you are buying options on the futures market, not in the spot market. Usually you see options underlying asset is based on the spot market, S0. But here is F0. Price signal come from the futures market. It's the dominant market. When a call is exercised, the holder acquires long position in the futures, a cash amount equivalent to the maximum of the futures price over the strike price or 0. So maximum is in this case is not ST minus K, it's FT minus K, okay, for a call. For a put, it's same there, but it is K minus FT. Potential advantages of futures options over spot. This is important. You better understand this part very well. Futures contract may be easier to trade than the underlying asset itself because futures, you've got a range of contracts. Exercise of options does not lead to delivery of underlying asset. It's always offsetting. Futures options and futures are usually traded in adjacent bits of the exchange, so not so relevant with the electronic trading. It's nearby, next to next. Futures options may entail lower transaction costs because the pricing is available at any time. You don't have to calculate so much. So an example is given here. An investor buys a July call futures option on gold. Contract size is 100 ounces. Strike price is 1300. Exercise decision. The investor exercise when the July gold futures price is 1400. Is 100 above the strike. And the most recent settlement price is 1390. So the outcome is the investor receives cash equivalent to 1390 minus 1300 times 100 is 9000. This is an offsetting position. So you are not going to deal with collecting the underlying. The investor receives a long futures contract. The investor closes out the long futures contract immediately for the gain. Let's say 1400 minus 1390 times 100 is 1000. Total payoff is 10,000. 9,000 there and 1,000 here. So you have got two things down here, right? Don't have to worry so much here. Put call parities we have discussed enough. We have tested it in the earlier. Black's model is not in our syllabus. Okay. So that ends the lectures today. Right.